Good morning, ladies and gentlemen. Welcome to 2023. I wish you a very happy and prosperous and healthy new year. Well, I want to do something slightly different today as an introduction to 2023. Have a quick look at 2022 and what I think is likely to happen in the first part of 2023. But for now, I think this is what is going on, and that good news for the economy is still bad news for all assets. The only way we're going to get an improvement in mood is to actually have a definitive shift in the economy, and then we will know which way to put all our chips, whether to put it all into bonds or keep it slightly hedged in both bonds and equities. The only thing that will tell us when the timing is going to be the yield curve as usual. And with that, let's have a look at what the yield curve is saying at the moment, and it's very much undecided. Before we start looking at the yield curve, let's have a look at the individual components. Absolutely no change in the 3-month. It still seems to be going to this upper line, which is around the 490 area. That's 3 months, 1 year as well. We're just not turning the moving averages or the Bollingers. It's still going up. And the 2-year, well, what can one say? It's basically in a range. I would have thought that the odds of trading above 455 are almost nil ahead of non-farm payroll. Non-farm payroll is going to be the big data next week, and that will decide which way we go. But certainly if it's 455 on non-farm payroll day, the odds are that we go lower and that it's a lower number. I just can't see the very short end doing much better, but I can't see it doing much worse without data. If the data is strong again, and there are absolutely no reasons to think it's going to be weak, because no news came out during the month of December to indicate that that the economy is going to drop off a cliff and unemployment is going to soar. We just saw no indications of that. That basically tells us that we have a floor under the market around this area, around 426. But also, common sense tells us that the longer this lasts at these yield levels, the sooner then the economy should roll over. It's just a question of timing and waiting. To me, being aggressively short futures at this kind of level, the 455 ahead of non-farm payroll, is silly. I would much rather be short after it at higher levels than there before it. If we look at the others, they're much the same. They're basically going back towards the levels that we were at when we got the first really bad figure for CPI. I think it's very unlikely that fives should go above 406 ahead of non-farm payroll. We will probably be somewhere around there for non-farm payroll, and then I think the danger is to the downside if it's a bad figure. Basically, we're waiting for everything for a bad figure to decide which way to go in asset allocation, and I'll show you that later, because the bond against the equities ratio is very much in no man's land, and we need to get the next signal. Tens 3.99 to 4% is where the risk-reward balance will lie, and in the 30s it's going to be again at around 4.05. What does that give us for the yield curve? This is the one I'm watching, which is 3s 10s. It's beginning to roll over, and that to me is a signal that we are on the cusp. We are waiting for something that's going to give us a good indicator. I would have thought that as soon as 3.10s, you get a bullish signal from the 3s rather than the 10s, that will be it. At the moment, you're getting a more of a bearish signal from 10s rather than you're getting a bullish signal for 3s. If you look at 3s, they're not moving. It's the 10s that are giving up some, and basically going back to where they were when we got the CPI figure. That isn't good per se. That is an indicator that we are actually, that the market is actually expecting more bad news, as it were, i.e. that employment is strong. And very much the same thing in 5s 30s. This move back down is a result of the 30s doing worse than the 5s. So at the moment we are not getting the signals that we want or that we need to be able to decide which way to allocate funds. While this lasts, I think we are in a range from these levels, from around 5 basis points up to 11 basis points. We really need much more of the short end coming off to give us a signal, and we're just not getting it. It's going to be a question of patience. The reason why we're not getting any signal from the short end is because of what is happening in Germany and how that affects the spread. So now let's have a look at Germany. And here we have the Schatz. It achieved the 268, stayed there for 3 days, and it looks like it's pissing straight through it. Now, what can one say? There is nothing that is, bullish for prices and bearish for yields in this chart. If we turn that to a monthly, you can see why the 268 level to me was important, and I thought we'd reach it. Now whether it goes through a few, who cares? But it looks to me like there really isn't going to be much resistance. If it can't hold 268 after NFP, you are looking for 341. And that's a big move, okay? So that's what, another 70 basis points? And you can see that, if I go even further back, it's almost guaranteed to trade those levels. It took 1, 2, 3, 4, 5, 6 months to reach it, but it reached it. I don't think that this time it's going to take 6 months. I think the market is in that kind of a mood, and the ECB is in that kind of a mood, that it's going to take the market there within 2 months. So, this is the kind of thing you're up against in the US bonds. If you look at the bubble, you are almost guaranteed to trade this kind of 315 level. And if you look at the Bund, the next real resistance level is there at 290, let's call it, 289, 290. And there is very little alternative to going there unless the economies really weaken. that is the problem at the moment, that even if you get inline numbers, the bond markets won't like it, i.e. they'll just continue their trend. And if they continue their trend in Europe, that puts pressure on the US. Why does it put pressure on the US? It's because these spreads are getting compressed to levels that they have always, traded sideways from. This is the monthly twos, and you can see that you've had a lot of trading sideways when it gets to something like 150. So if you do the maths, and the Schatz is going to go another, let's say, 60 basis points, and this spread is only going to come down another 15, it puts pressure on the 2-year in the US. If you have a look at the tens, and let's say that it gets to these levels around even 110, let's call it. Okay, let's say that it gets to 110, and you can see how much it trades sideways when it gets to 110. Well, that is going to put another 20-30 basis points of pressure on the US tens. So you can see what we are up against. We're not so much up against really bad news in the US, but we are up against differentials that are pushing higher the yields in the US. Or at least they are not giving it any respite. And what with QT and the big issuance program, that is just something that the US alone cannot, just cannot fight. It just sort of trickles away. Let me try to put it another way. I'm not saying that the yields in the US are not appropriate. I am just saying that the pressure from other bond markets and the fact that we have QT and that we have no help from the data, unless and until we receive it, the path of least resistance for the US is going to go up in yield, because the other markets are going up in yield more, and therefore putting pressure on them. And unfortunately, there's nothing much that the US can do while that situation persists. How does what I've just told you about the bonds impact stocks? Well, this is a weekly chart of SPY over SHY. SHY is, 1 to 3 year maturity bonds. And you can see that because the yield in the 1 to 3 year area is in the, let's call it the mid fours, it's very difficult for SPY to fight it. Money is being drawn into the away from risk and into the safe yields of government bonds, which, if they're going to stay in the fours, mid fours, high fours, who cares? It's still a lot more or a better bet than the stock market, because the dividend yield there is lower and the risk is higher. And therefore you get this pattern of, revert to mean, come back down, revert to mean, come back down in SPY, SHY. If we look at SPY over IEF, you get much the same kind of pattern. What it just means is that SPY cannot break higher. SPY TLT, it's basically just going sideways with a slightly upward bias. But if you look at the totality of the bond market as against the totality of the stock market, you are getting basically a holding pattern. And this holding pattern will basically allow stocks to go up 4 or 5%, allows them to come back down 4 or 5%. But until we have broken out of these ranges, all it means is that the stocks will more or less track the totality of the bond market. And it's really a toss-up whether it's bonds that do better or equities that do better. You know, one week it'll be a couple of percent one way, and the next week it'll be a couple of percent the next way. But it's not a trend. It's a holding pattern, and we need to wait for that to break. Now, if you get bad data and you start getting really bad data on the real economy, this finally will start breaking down and coming back down to these levels. And then you will have the divergence, or basically, to say better, you will get the way that risk on and risk off should trade re-establishing themselves, i.e. you will get bonds doing better and equities doing worse. At the moment, it's just an up-down between equities and bonds without any resolution. That is what we're waiting for. We're waiting for the old rules of risk on and risk off to re-establish themselves, and then we know we either are bullish bonds and bearish equities, or vice versa. But at the moment, you're getting a complete mishmash between them, i.e. money moves in and out of them without any trend being established. In 2023, I am sure that situation will break, but we have to wait for it to break, and the only thing that will do so or cause it to do so will be data. Unfortunately, we are 100% like the Fed, data dependent. This is QQQ over TLT, and you can basically see that since 2021, very early 2021, we've just been going sideways. Whether you prefer TLT or you prefer the Nasdaq is immaterial. You've gone nowhere. So if you'd held bonds or the Nasdaq, you've suffered in equal measure. That needs to break. And I think this will be the one that breaks first and gives us the clue. And that's the one I'll be watching in 2023 very closely. You know, my favorite break is going to be to the downside, because that means the Fed is going to ease. That will cause the yield curve to flip back towards positive, and it'll give us a humongous move in the short end. But it's not happening yet. And you know me, I have strong opinions, but I am led by price. I don't put on positions which are not confirmed by price, and I put on big positions when price confirms, and it goes into, you know, with my fundamental beliefs, i.e. the technicals and the fundamentals have to marry for me to have a big position. At the moment, that is just not happening. In terms of risk, the market is very much still telling you to be defensive and conservative. This is TLT over GLD, so bonds over gold. And you can see that we are making new lows. And if we go back in time, this is a weekly chart. We are now breaking the lows that we made around 2011. Of course, this is slightly distorted because TLT gives you dividends and gold doesn't. But it just gives you the trend that people still prefer an asset which is, you know, non-yield bearing to bonds yielding you, you know, 30-year bonds or the TLT 17-year duration yielding you 4%. That is worrying, okay? That is very worrying. And if you look at SPY GLD, that is also not looking very healthy. If it breaks, and that's another thing I'll be looking out during the first weeks of, throughout 2023, is it starts breaking this 216 level, it's going to go all the way down to 188 without any problem. And that's nearly a 20% move, right? So what that is saying is that gold seems to be a better refuge than assets at the moment, and that is really runs counter to my narrative that at some stage CPI is going to absolutely collapse and you're going to get a disinversion of the curve. The only way this could work and this collapse is actually if you do get that, but then TLT has to rally to somewhere up here. Gold TLT has to go up very violently. So at the moment you're seeing no sign of that from gold TLT, but that is something that gun to head. How is 2023 going to end up? It's going to end up with gold TLT up here and SPY GLD down here, which basically means that gold is going to do probably not very much, bonds a lot better, and stocks a lot worse. That's gun to head, but that is a data which says inflation is no longer a problem, CPI is coming off hard into the twos, and the economy is flipping over, and it's looking very much like we are in a deep recession. Those will be the numbers if that happens. But there isn't a single chart that is saying that at the moment. Okay, and I just don't bet on things that I think make sense without price confirming it. And it's just doing the opposite at the moment. I'm just telling you it's doing the opposite of what I think it should do. The only indicator which is favoring my point of view is GLD over DBC. This chart is telling you basically that, and this is the line that I had, if you remember, I'm going to put it in again on this chart, where I started preferring gold in my allocations to commodities and oil. This one, if I am correct, and the economy turns over, is going to be very violent to the upside, at least this kind of level, at least 9, let's call it 9.25, something like that, which from 688 to 9.25, that's a big move, especially if gold does nothing. And then you must get a complete collapse in oil, because DBC is mostly oil. So that's the only indicator that is favoring starting to favor my point of view. Say it goes to here, 920, right? Perfectly reasonable, right? As in terms of a retracement. Well, that is from 680. What is that? That's almost 30%. So you're talking about a move that favors gold by almost 30%. And unless bonds rally, I can't see gold doing that much better. So you're talking about all of it being reflected in DBC. So I don't know. This is going to be the joker in the pack and the one to really watch next year. Because if this is correct, you are going to, at some stage, get a really good bond rally, a really good, decent gold rally, less than bonds. But also you must have a move down in DBC, and you also must have a move down in equities as well. So for next week, I think very little is going to happen ahead of non-farm payroll. The first couple of days, you're probably going to get some buying because it's the new year, new funds get allocated, whatever's come in will, be invested. I don't think it means anything at all. So this monthly chart, I think, is beginning to be clear. Every time it gets to this red line, I will be a seller. So this is going to come in around, what's that, just below 4,000. The risk reward just around there is to the downside. These Bollinger Bands are slowly starting to open up. And don't forget, this is the same pattern that we saw in 2007. And you will remember that the recession didn't actually come in until 2008, or very late 2007 is the time when we got this pattern, and then it just collapsed through, and every month it just traded on top of these monthly Bollinger Bands. But you can see where they come in together with this 200-month moving average. The confluence is right there. Just below 3,600. And to me, that kind of level is definitely going to be a bounce level. Tells me more of the same but the market should remain weak. And if we look at the dailies, it also basically tells you that every time the market hits these levels in the 3900s, it's going to be offered, and the big support 3700 or just above it, let's call it 3740, just before non-farm payroll. I think there's zero chance of seeing that before non-farm payroll. We are more likely to trade slightly higher in terms of, because we need the allocation somewhere 38.55 or slightly higher. But this is actually reflected very well in this 195-minute chart. You can see how tight the Bollinger Bands are now, and basically on Tuesday, they're going to say that we're in a range between the high 3800s and 37.75 in SPX on the downside. It's all going to be on non-farm payroll. I think any move up towards this 39.10 area, which gives you 39.40 in ES, is going to be very difficult to break, and in fact it's probably going to be a very good sell, especially because of all the different risk indicators I've shown you throughout this video, showing that there is really very little to choose between bonds and equities at the moment, and the relative moves are only a couple of percent up or down, and they're negated every other week. So net over the course of a month, very, very little change between those assets. And that tells me that we are still in a regime where good news on the economy is bad news for all assets, including the stock market. It might be slightly better for the stock market, but it's not good. Last chart I want to leave you with in this introduction to 2023 is SPY over FEZ. The States over Europe. What is amazing is that it closed exactly where it was at the beginning of 2022. So in 2022, there was no relative movement between the stock markets in Europe and the stock market in the US in dollar terms. If you, and that is weird, because, I don't have to tell you about the war in Ukraine and stuff like that, and that the onshoring and everything, the deglobalization and so on, should favor the US in a big way. If if the US goes into recession, Europe will just fall apart. Where are they going to sell their goods? To me, this is very weird. I understand the argument that it was very overbought, absolutely, but that it should end up at the same level as 2022. Okay, you can say that the Europe has more defensive stocks and stuff like that. I just find it very difficult to believe that this can keep going. But, I'm not going to fight it. What I'm just going to say is that if they're tied together, the risk reward is actually to sell Europe rather than sell the US, even though it has even though the US has the more growth orientated stocks and Europe the more defensives. However, that argument that you're talking about more defensive indices doesn't really hold water, because this is the Dow against FEZ. And you can see that if it starts breaking this level, something is going on. Does it portend an end to the Ukraine war? I don't know, but I have my alarm set at that level, because if it starts going through, something very big is happening and will continue to happen. No way, if we break this range, we are likely to come down to at least down here, and that's a 10+% move relative between the Dow and the FEZ. Something very, very big will be happening, and I all urge you to watch this line in 2023. I don't know what the explanation is. I'm not that clever, but I just know that if that happens, it'll probably be obvious. And let's face it, it doesn't make any sense that FEZ should be favored in a period where interest rates in Europe are outperforming to the upside interest rates in the US. So if this starts going counter, something big is happening in macro land to the narrative, and we have to re-examine everything that we thought so far. Unfortunately for all of us who would like to see a quick resolution in terms of, do I buy equities, do I sell equities, or do I just put all my money in bonds and go away, VIX is saying that we are not going to get a resolution to that question anytime soon. It's more likely to fill these gaps down to 19%, and there's another one here from April down to 1856, rather than going straight up. It's actually turned the 200-day moving average, which tells me that we're going to basically trade sideways for quite a while. It could be, it could be several months before we get a resolution to the questions we've asked. I'm sure we've asked the right questions and that we're looking at the right charts. It's just that we don't know what the resolution is going to be. But VIX tells me that this market is not ready to break to the upside yet. And I think you have to have even a modest break to the upside, i.e. into the 30s, to get the kind of switch in allocations that I expect for later on in the year. We're just not in a position to do that just yet, unfortunately, which tells me that probably Q1 remains strong in terms of what the economy is doing, and bonds continue to bleed, and that continues to drag on the performance of equities, i.e. equities do slightly better than bonds, but they don't do that much better. They do 2, 3, 4, 5% better, which is relative stability in equities, and maybe slightly, a greater bleed in bonds. With that, I'll leave you with the updated levels. I don't think very much is going to happen before non-farm payroll. You're watching at these levels to the upside now. I will naturally tweet you a counter trend trade there in bonds ahead of NFP. But if after NFP we start crossing these levels, you are looking probably at the test of the old highs in terms of yield of last year, and that can't be good for anything. And with that, a very happy 2023 to you all. Much happiness, prosperity and health to all your families.